What's going on, guys? Welcome back to the roll-up and for our Bitcoin and Beyond series. Today we have Sankha Banerjee and Robbie from the roll-up and Sankha from Babylon to talk about economic security, restaking, and some interesting Bitcoin primitives that are being built over here in the Cosmos land. Rob, good morning, sir. How you doing today?
A beautiful day in Florida, Andy. It's good to be here.
Nice.
Good to be going to be talking restaking in the Bitcoin world with Sankha. Restaking is all the memes these days. Eigenlayer, of course, has been doing quite a bit of restaking on the Ethereum side of things, and so now we're seeing this new world on Bitcoin blossom. And so I'm very, very curious to see and hear from Sankha about some of the implementations that they have on Babylon. Sankha, welcome.
Thank you guys for having me.
Thank you so much for coming on. Maybe you could tell us a little bit about the origin story of Babylon, how you guys got to where you are today.
Yeah, so Babylon is a Bitcoin staking protocol. It was founded by two of our co-founders, Professor David Say at Stanford University. He's an information theorist. He has actually been in blockchain over the last 5 years, predominantly working with the ETH Research Foundation in helping them with work from proof of work to proof of stake. So some of the core ideas in kind of evolving into developing the Babylon protocol came a lot from his experience, as well as our other co-founder, Fisher Yu, has been a postdoc and a research student of Professor David. So they were basically the incubators of the idea. And I joined the protocol roughly one year, 2 months ago as the chief protocol economist. So I kind of worked mostly on the mechanism design and the business model for Babylon. And it was very helpful and a bit lucky that we kind of build this protocol in the Bitcoin Renaissance era. So really excited to talk about it.
Yeah, definitely. I mean, you guys kind of came on the scene like quite abruptly, if you will, over the last like 3 to 6 months, more than kind of most other Bitcoin projects. And it was actually kind of an interesting time with Eigenlayer too. Like you kind of have like these two dual like teams building out like similar ideas. At its core, they're the extension of economic security, but kind of different. How do you kind of see the core idea of extension of Bitcoin economic security? Like if you had to explain that as like a foundational concept for us, like how does that work and what is that idea?
Yeah, so we a lot of Sriram from Eigenlayer was a postdoc at David's lab. So we have very good relationship with the Eigenlayer ecosystem and the Eigenlayer co-founder. But fundamentally, in terms of the idea level, we're actually very different. So in case of Eigenlayer, you have the ETH stakers who are already getting the base staking rate, and now they can opt in to get more staking yield, and in return they can actually opt in to take more slashing risk, which is what they are being paid for in terms of staking yield. In case of Babylon, we're actually going to Bitcoin, which is a proof of work chain where the word staking was never there. So Babylon is like the first protocol to actually bring the word staking to the Bitcoin nomenclature. And what we are trying to say here is that Bitcoiners can actually lock their Bitcoin on the Bitcoin blockchain. It never leaves the Bitcoin blockchain, and they can actually take on slashing risks from POS systems to get staking yield. So Eigenlayer is built on the word restaking because the Ethereum staking is already there. In our case, we're actually first building the word staking to the Bitcoin nomenclature, and then once you are staking, you can also do the restaking. You can enable your restaking. So fundamentally, we are actually building like an ecosystem or a base layer of Bitcoiners who are interested in taking this slashing risk. They can actually opt in to get staking yield from POS systems.
Awesome. We had a previous presentation with the project CoreDAO, also as part of Bitcoin and Beyond, and Rich from that team mentioned this OP time lock. I'm curious if you use a similar mechanism. If so, it makes sense how we lock that Bitcoin on the network. The slashing part of that, I'm still quite curious about. If you could kind of expand further on the technical.
Sure. So yes, we do use the time lock, and fundamentally the time lock is very important because the time lock signifies the lock which if you are taking your Bitcoin, locking it on Bitcoin, and you're like importing the dollar strength of this Bitcoin into a POS system, the POS system needs to be confident that this Bitcoin is locked, right? Because or else the economics of staking completely gets not in the right frame. So fundamentally, before I get there, I want to make this one point that in proof of stake, um, the staker is bonding his capital in order to put economic security in order to validate the blocks. So if he, so these are the validators. You can think a group of validators producing, they're creating this block, and once that block is created, from the reward gets pushed back into a validator pool, and each validator based on its economic weight gets a part of that reward, right? Now, what's very important is that the system, the proof of stake system, needs to know that this economic weight is bonded for a lot longer time than actually the block production time, right? So that even if in the case of slashing, it has enough time to understand if there is a bad behavior in the system. So the word lock is very important. So that's where now if we come back to the Bitcoin ecosystem, the time lock is very important, right? So imagine we are going into the Cosmos ecosystem where the stake bonding time is 21 days. If you are not able to do the time lock on Bitcoin, this dollar voting power would not have the same security guarantee to that proof of stake system than its native token, right? And that's the philosophy of the time lock. But let's go through a user story of what Babylon's Bitcoin staking, like if you're a user and you want to stake your Bitcoin. So basically we have this script which has, so you come in and you want to sign on this Bitcoin script using your public key, and it's basically a UTXO transaction. And what you're doing is this script has two parameters. One is the signing aspect of the script, but the other two parameters is how long are you planning to lock this Bitcoin on the Bitcoin chain? And the second is once your Bitcoin has been locked on the Bitcoin blockchain and you are delegating the dollar voting power to a POS chain, let's say a Cosmos chain, uh, if the validator to which you are delegating this dollar voting power double signs, then we have the validator or some external agent has the power to slash you. So in order to slash this Bitcoin, that's the third parameter that you are giving the right that if the allocation of dollar voting power which you are doing to the validator and that validator double signs, then there is a way to slash you, like slash your Bitcoin, right? So that's the third parameter. And so fundamentally, the Bitcoin staking script has these two very important parameters. One is how long are you staking your Bitcoin, which is the time lock. And second is when you're delegating the voting power of this of this Bitcoin locked on the Bitcoin chain to a POS validator. If that validator double signs, there is a way to slash your Bitcoin. So that's basically the journey. But let me walk you through as if I am a Bitcoin holder. So I come in, I sign this script. Let's say I want to lock my Bitcoin. It's very standard, the Cosmos bonding period, 21 days, right? So I'm locking my Bitcoin for 21 days. And I'm also signing on that if this Bitcoin dollar strength, which I'm, let's say, delegating it to Figment, if that dollar strength is given to Figment, and now Figment is signing blocks, let's say on Babylon chain or Cosmos Hub, if at some point at a certain height, Figment by mistake or for some reason has signed two blocks at the same height, that's a double sign in POS nomenclature. And now a part of your Bitcoin, which has been used to do this signing, would get slashed, right? And so that's basically the mechanism. But what's very interesting here is the word slashing. How do you incorporate the word slashing in the context of Bitcoin? As we know that Bitcoin is not smart contract enabled. So how are you making Bitcoin enable this slashing mechanism. So that's where we are using a technology from cryptography. It's called one-time extract signature. And the mechanism of this one-time extract signature is that if the validator is signing two messages and these two messages are at the same height, then the one-time extract signature function is able to uncover the private key of this dollar delegated delegation. And now, once it has uncovered this private key, anyone who has access to this private key can actually go and take control of the dollar amount which has been used for validating these blocks. And so what we are making, it's a little bit of a watchtower kind of situation, that once this one-time extractor signature uncovers the private key of the validator, anybody who is watching this system can actually go to that private key and take that Bitcoin and move that Bitcoin from the validator's position. So in that way, we are kind of emulating the slashing phenomenon.
And would that be like they would be able to take all of the Bitcoin in that private key, or just a certain amount based on some other parameter?
Yes. So basically, you're pre-signing of how much amount you are comfortable to getting slashed. So it's not going to be all it's basically a pre-signing even before your voting power is activated on the POS side. You're pre-signing of how much Bitcoin you're willing to get slashed. And based on that, your dollar voting power would be picked up. So it's not going to be all your Bitcoin.
Gotcha. And so why would one delegate, like, and maybe the answer is because you can get more yield, but maybe it's a little bit deeper than that. Like, why would I, as a user, delegate and not choose like the minimum amount of viable slashing to still be able to participate in the system? And then user B would then do much more. Like, why would one user differentiate their total amount from others? Is it a yield thing? Is it
No. So there's an economic rationale behind it, which is basically so just to give you the stats on slashing. So when you allocate $100 to slashing, generally the slashing probability or the slashing risk is between 3 to 5%, right? So and partly why these LSDs have come around is because before the LSDs, people had this huge capital inefficiency problem with the amount of stake which is being allocated, right? So that's where the LSDs came, and they try to create more capital efficiency on your lock. So given we know this number, that if you are staking $100, the most in the case of a double sign you can get slashed is $5, like roughly 5%. And I'm just quoting these stats from, like, let's say the Cosmos staking slashing rates, right? So what happens is, let's say you have two stakers, and initially your idea is you just want to, let's say both the stakers have $100 to stake, $100 in terms of Bitcoin wealth. Now one staker says, I only want to get 1% slashed. The other staker says, I only want to get 5% slashed. Then the chances are that the validator is actually going to pick the 5% one, because he wants a little bit of cushion, right? So if you as a staker keep a very low slashing amount, chances are you might not get picked up by the validator in the active voting power.
Gotcha. Cool. Okay. Rob, did you have a question as well? I think that you had something there.
Yeah. Around the private key. So when I signed this UTXO to lock my Bitcoin on the Bitcoin network, my Bitcoin stays in my wallet, right? So my private key I signed this transaction, and this is the transaction that is associated with my private key. When I signed that UTXO, I'm curious as to how unlock that one-time extractor signature doesn't give the private key for my entire Bitcoin wallet.
So this is very important to differentiate. So let's say you're a Bitcoin holder and you have some amount of Bitcoin. Then your private key of this personal wealth is different than the private key which you are generating when you are delegating it to a validator. So what we mean here is the private key of that delegated validator account rather than your own private key.
Got it. So we generate a different private key when we delegate this time block Bitcoin.
Yes.
Awesome. Okay. That makes sense. And so how have you seen the adoption of this across the ecosystem? like on the Bitcoin side as well as the validator side on Cosmos?
Yeah, so I think this is where we want to go a little deeper into the economic stats, right? So fundamentally, we have in Bitcoin, fundamentally people buy Bitcoin because they think the price of Bitcoin eventually is going to go to the moon. Now with this institutional adoption, people at least know that Bitcoin is here to stay. There's this whole like passive asset management industry, which is trying to allocate a part of their portfolio into Bitcoin. Bitcoin is more looked as an inflation resistant asset. It's kind of looked as more like digital gold. You can't have like $100 million of gold and move around, but you can have $100 million. So the fluidity of holding Bitcoin is actually a very important use case in the adoption of Bitcoin. So fundamentally, the use case of Bitcoin has been to do nothing and just hold, right, and hope that it just keeps going, move up. So the first use case I would say which came to Bitcoin was like wrap Bitcoin. So people would put their Bitcoin into a custody. They would mint an ERC20 version of Bitcoin, push that into lending protocols like Aave. So the yield which you can make annualized on that kind of operation is roughly maybe the max is a 1% annualized yield, right? So it's very minimal compared to everything which is out there. So the ETH staking rate is roughly 4.5%. So what has been happening is people who own Bitcoin, they push it to custody, then they somehow collateralize it to ETH, and then they stake it on ETH, and now they're making some ETH staking yield. So what we felt that staking is such an important use case to bring to Bitcoiners, and the reason why Bitcoiners might be very interested in taking on this slashing risk is because the slashing risk, specifically the double sign, is objectively attributable, as well as it's verifiable on chain. So nobody can actually really take your money away without having proper digital proof that this slashing has happened, right? So it's a very strong signal of the type of risk you are taking, and it's very documented. So given that, we looked very heavily into the ecosystem, that what are the things which fundamentally this massive base of passive asset holders are not willing to do. So the two risks which we identified which they're not willing to do is do external custody, and second is bridging, right? And in Babylon's design, we actually have none of this. So you're not sending it to anyone, as well as you're not bridging. So it's a self-custodial design. So given that, we feel very strongly that if we can actually improve on what are the yield potential which is being offered by Wrap Bitcoin, we are able to suck in that whole market, as well as right now, over the last 18 months with the bear market, we see that a lot of the crypto economic dApps, and they're extremely concerned of not giving high inflation bootstrapping to their products, right? Because most applications or even existing chains, when they're giving out 18%, 15% of annualized APY to their validators, in some sense, that's a sell pressure, right? Because the validators are eventually going to liquidate a part of that thing, specifically if the token keeps going down, right? Because eventually there's this calculation of what's the cost basis for a validator to run his operation, and the tokens he's getting, does that even make sense? So in some sense, what we've seen over the last 18 months is the validators are becoming probably one of the biggest systemic sell pressures, because they have to cover their own cost basis, which is actually in dollars and not in native tokens, right? So given this scenario, we think that Bitcoin holders, they actually have the lowest cost of capital with the highest security. So if you can onboard such a capital, and this is very relevant in our collaboration with Cosmos Hub, that Cosmos Hub was roughly paying annualized 10%. So if you think that the Cosmos Hub security budget is like 2 billion, 10% is 200 million. So roughly 200 million of assets have the option of coming back to the market. So in a bear market, this takes a toll on the tokens activity. So here, if you are onboarding Bitcoin capital, and the Bitcoiners are happy, rather than 200 million, they're happy to take 1/4 of that, right? And now you're saving economic tokens which could be used to incentivize economic activity. So our thesis has been that we feel, compared to what type of yield is available for Bitcoin holders, and that Bitcoin staking through Babylon would enable Bitcoiners to get a more competitive yield, because we see this huge market in POS, which also wants to reduce the type of inflation they're giving to their participants, right? So fundamentally, we're trying to map high security, low yield expectations from Bitcoiners to like a stable inflation environment for POS systems, so that they can really focus on bootstrapping the economic activity.
It's a win-win. Yeah, I mean, Bitcoin, like you said, I think the last sentence there really struck home, which is that Bitcoiners don't have a high expectation of yield. And so they're able to make more than they are accustomed to making. Cosmos, they're accustomed to paying out 10% yield. That would exceed Bitcoiners' expectations. So they can sort of meet in the middle, and both of them end up better off. Andy, did you have something there?
Yeah, I mean, I think hit on a lot of like the economic kind of aspects of this, and this is kind of like what we were talking about prior to actually recording, was a couple things. One being like this, like economic security a meme, which I'd like to get into in a second here, but similarly to like the eigenlayer, like AVS realm, like what kind of applications do you expect Babylon to power, or like why are you guys building this extension of economic security to power what, or to like accomplish what, is kind of like what I'm trying to understand.
Yeah, great. So I'll take that first question, because I do see that it's a pretty hot debate, that is cryptoeconomic security a meme. Um, I think it's a way to look at it, right? So, and it's kind of like this: the glass is half full and half empty. So, for ecosystems which don't have a massive TVL, right? Like I would say, Ethereum has probably the biggest TVL, and then Solana is doing very well too. The concern is that when you don't have a lot of TVL, then the economics kind of doesn't come into play. Then it's more like usage, what's the user interface, what are the type of products. But when the TVL comes to your play, then one of the factors which you want to do is make sure that that whatever you're doing on the consensus level, it does not reduce the economics which you have built on top of it, right? So I think one of the ways to think about cryptoeconomic security is, do you want to do something at the consensus level, any form of decision making, any form of mechanism design, which can impact the economy which is built on top of it, right? And I think where eigenlayer is very important is that fundamentally what they showed is that the middleware security and the consensus level security, they're not standardized to be the same security, right? And that's where they have a very nice plot, that they have been able to bring eigenlayer to standardize the economic security of middleware as well as a base consensus layer, right? So there can be a situation where the Oracle security and like an app security is at the same level, which before this restaking narrative, this was not able to do this standardization, because consensus, like ETH consensus level security, they were not able to opt in to provide this security, and as a result standardize the security between the consensus layer and the middleware layer, right? So for Babylon, we are right now, the first attack we are trying to do is we're going after existing POS chains, starting with the Cosmos ecosystem, because we find that the most of the apps on the Cosmos ecosystem are existing chains. Like, let me give you an example. Like, there's a cloud marketplace, right? The cloud marketplace, it brings in a lot of GPUs, a lot of supplies. The tender is being given out in the native token, and then the buyers of this supply are also paying in the native token. The problem is, this whole marketplace is standing on the stability of the token, right? So imagine you come in when your token price was $1, and you create this agreement, but then suddenly the token goes down to like 50 cents. So if it goes down, the security of that marketplace becomes a massive question, right? So for us, what we are trying to do with Babylon, specifically in the Cosmos Hub, and we have some other ambitions too, but right now focusing heavily, is we want to give every marketplace a stability to their token price, because it's almost like a tranching where you have the Bitcoin capital, which has the most stable volatility, and it also has very stable expectations in terms of yield. And then you can actually put on top of that the native token if you want to have it as a dual quorum model. But fundamentally, that helps the stability of your economic marketplace, that the people who are participating in that marketplace, they're not concerned that, hey, these validators may actually opt out, and now the security is a concern. This blockchain can have other issues. So we feel very strongly with the partnerships we have with Cosmos Hub. Cosmos Hub has two other consumer chains. One is a DEX, Neutron. The other is a liquid staking provider called Stride. And there are a few other Cosmos Hub chains, as well as we are reaching out to some of the more important upcoming Cosmos chains, as well as some existing Cosmos chains like Axelar, where we're trying to understand how can we bring this Bitcoin security to the Cosmos ecosystem to help the stability of the security marketplace.
Isn't crypto just inherently like volatile though? Like you can't control the price of assets, but you can control the effects of price changes on your system.
That's a good point. But just to kind of reframe that question, so what I meant was fundamentally the thesis of the shared security paradigm is that we feel that people, no matter what, are going to hold on to Bitcoin and Ethereum, right? At least to start with. So if you have the holders that no matter what, they're going to keep holding, right? That's a very strong base to build on your security marketplace, right? So I think that's kind of one of the, I would say, like a good way to my feedback for this, whether cryptoeconomic security is a meme. It is a meme if the economic security is being built on a token which is not really that stable. But fundamentally, if you look at Bitcoin and Ethereum, it's almost the top two assets which are competing right now with traditional markets too, right? So nobody who is buying Bitcoin, they have any short-term thinking. They're basically holding it as generational wealth. And so if that idea still prevails, the marketplaces for offering shared security on Bitcoin through Babylon or on Eigenlayer, I think there is a value proposition here, because when you are bootstrapping a dApp as a protocol co-founder, you're actually not concerned on the volatility of the token. What you're concerned is that if the volatility of token creates sell pressure.
Yeah, I think it's going to be so glaringly obvious in like 5 years that like this was a viable mechanism to secure applications, especially ones which, if we get, I think in the next bear market, which what always happens in the bear markets is people hate tokens again. So like, I think like this model might be especially popular in the next bear market, if you will, where we have applications coming live without needing to like launch their own token or bootstrap their own set of nodes and things. So, you know, as like this kind of like logarithmic growth of ETH and Bitcoin plays out, that's almost like this S curve. I think it'll be extremely obvious as a volatility dampens. It'll make sense to have these sort of mechanisms that are a bit more flexible and can kind of bring more utility to different applications and for builders, rather than kind of relying on the steadfast like proof of work, proof of stake, like hardcore, like tech or metal, or just kind of like other forms of securing a network.
Yeah, so I think one point is important is, and if we look into the history of the internet, so generally if you look at like the AWSs of the world, right? If you're building a new company and let's say you have a big budget, most of the time your budget does not go into your AWS infrastructure expenses, because if it does, that something is like not aligned, right? So fundamentally, if you're raising money, you do have an expense from the infrastructure, but tends to be that the infrastructure expense is not like more than 5-6% of that whole expense. But if you look at crypto economy before Babylon and Eigenlayer came, it could turn out that infrastructure expenses were as high as 20%, 30%. So as a result, what was happening was that this amount of inflation which you're giving to bootstrap your infrastructure, it actually kills your economic idea which you are really trying to build. So I completely agree with your point that in 5 years, you will see that there's a standardization of infrastructure expenses through Babylon or Eigenlayer, and that basically completely cleans up the mind of the protocol founders that they should really focus on economic incentives, or the economic development of the idea.
All you guys have to do is just stay cool, stay calm, keep building, don't fuck it up. In 5 years, it's going to be like Babylon was so obvious.
Yeah. That's the plan.
I don't have a lot to add. I think that was great. We debunked whether or not economic security is a meme, and a lot more than that too. So, Sankha, thank you so much for coming on. It was enlightening to say the least, and very, very cool to see all of this activity coming to Bitcoin.
Thank you so much. Thank you for having me. Cheers.
Cheers.